Hello everyone, welcome to Investing Sucks. My name is Eric and thank you so much for tuning in. So today we're going to be taking a look at another TSX tech stock by the name of Well Health Technologies. And the reason I wanted to take a look at this company specifically was because I think that the industry they're operating in, the telehealth industry and the kind of online healthcare providing services industry, is one that has very good growth potential into the future, and I think it's worth taking a look at. So for me personally, I'm someone who likes to network, and just a few years ago, back when I was in business school, I was doing some networking, and I had interacted over the years with many different people who work in the IT space in the healthcare industry here in Canada. And what the general sentiment of those people was that this industry does have very good growth potential going forward because of things like the government of Canada pushing for modernization of the healthcare industry, and things like that, where it moves online, it becomes more efficient, and basically any company that is able to offer those services does have pretty good growth potential going into the future. So because of that, I really took an interest in looking into this industry a bit and kind of seeing what companies there were available, what different companies were doing to kind of innovate in this industry, and then kind of evaluate the long-term investment potential of that. And that's something I'm probably going to be doing just kind of on a research basis going forward. So that's really the goal of this video. So just because this industry has growth potential, does that mean we should just blindly throw money at any company that's involved in this industry and think that would make a good investment? No, obviously not. So what we want to do here in this video is just look at this company, let's get an overview of it, and let's answer some key questions about this company, or at least figure out what questions we need to ask if we want to evaluate the long-term potential of a business like this. And then as always, we'll do evaluation at the end of this video. But before I get into any of that, if you are new to my channel, I would greatly appreciate it if you would consider subscribing to my channel. I created this channel recently with the goal of just providing unbiased investing content to the retail investors out there and just the investing public at large. And my goal is to grow this channel to 100 subscribers. So if you could help me achieve that goal, then I would greatly appreciate it. But without further ado, let's actually get into the video now. So the first thing I want to do is hop into Morningstar here and just look at some quick valuation metrics of this company to kind of set the tone for the rest of this video. So in terms of valuation metrics, we really don't have a lot to go off of here. We can see no price to earnings ratio because they're not currently profitable, no price to cash flow ratio because they don't have positive operating cash flow for a full year yet. In terms of the price to book ratio, so currently, or the 5-year average is 8.8, currently it's about 7.8. And the index, this would be the TSX as a whole, is 2.2. So in terms of their price to book, they are actually relatively expensive, which is expected, right? They're a high growth tech company. Most of the time you're going to see these companies with pretty high price to book ratios. And then these metrics down here, specifically enterprise value. So we can see their enterprise value going back to 18 was extremely small. I mean, that's only about 30 million, and now it's ballooned to about 1.6, 1.7 million. And the reason for that is because back in this time, they were actually a completely different company. It was, I believe, at the start of 2018, they basically completely changed as a company and started implementing this new strategy of buying, health EMR companies, healthcare service providers, clinics, that type of stuff. So that's kind of why you see this drastic increase here. It's not because the company just became insanely more valuable. It's because they just completely changed as a business. Okay, so the next thing I want to do is talk about what Well Health actually is. So kind of what their business strategy is. So what they are, they're called an acquisitive company. So what this means is Well Health in and of itself does not provide any unique services, and there's nothing that Well Health as a company kind of offered. What they're doing is they're acquiring other companies, for example, other electronic medical records services providers, other billing services providers, other cybersecurity services providers, telehealth as well, even medical clinics themselves. They're acquiring all these companies with the goal of creating a much larger, more consolidated entity that can lead to increased operational efficiencies, and really they can provide a suite of services to healthcare clinics across Canada and probably across the US and other countries into the future as they choose to expand. So their goal is really to become more efficient, right? It's better if you have one company offer you a much larger suite of services. For example, your billing, cybersecurity, electronic medical records, and so on and so forth, versus having different companies provide all those services. So what they're doing is they're just buying various companies that provide different services and then consolidating them into one entity. So what I've got here is their management discussion and analysis file. And if we go to the first page in the company overview, it details basically what I just talked about, which is Well is an omni-channel digital health company whose aim is to positively impact health outcomes by leveraging technology to empower and support patients and doctors. The company owns and operates 27 healthcare clinics provides telehealth services to thousands of patients daily, and sells practice management software tools to medical clinics and healthcare practitioners. So they talk about electronic medical records here, which is EMR, and then different software and services, digital health applications, billing, cybersecurity, and a variety of stuff. And they even mention here their acquisition of CRH Medical, which is a very large acquisition they made in April of 2021, so right after this came out, which this was designed for their March 31st quarterly filing. Okay, so now that we understand what this company is, let's actually look at how they make money. Okay, so I've pulled up their most recent quarterly filing right here. So this is as of March 31st, 2021, and I've gone to the notes of the financial statements and the note 5, which talks about a breakdown of revenue. So we can see their major revenue source at the top here is public insured revenue. So that accounts for about 30% of their total revenue for this quarter alone, which is down significantly if we compare to the last quarter. Not because the revenue in and of itself has decreased, but just because it now makes up a lot smaller of a percentage. So this is just due to the acquisitions that they've made over the time. They've made more acquisitions, as we can see here, in the software and services space, where revenue went up from about 1.7 to about 7.6 there. Whereas there was a little bit of growth, but not much. So what public insured revenue is, it's really revenue from actual patient visits. So when a doctor interacts with a patient, either in person in one of their clinics or on a telehealth platform, and it's eligible for reimbursement under Canada's public healthcare system. So that's why it's called public insured. And that means that it's a lot more regulated than some of these other ones, because it is eligible for public reimbursement. Now, these other non-insured services could be things like online mental health assessments, and then in software as a services, you're probably looking at the electronic medical record side of it there, which is particularly high margin. I think really here's why you're investing in this business. That's where most of your organic growth is going to come. You will see these numbers change a lot into the future as they continue to make acquisitions. So it's going to be hard to determine how much organic growth you've seen when you're looking at year-over-year comparisons of revenue numbers, but this just gives a good breakdown of kind of what we can expect. Now, this other non-insured revenue stream is one I personally find particularly interesting, just because it encompasses online mental health assessments. And I think that online mental health assessments and platforms that provide those services are going to see significant growth into the coming years, and probably even into the coming decades. As sad as that is to kind of say, it is the reality of the world we live in. Mental health issues, especially in young people, have been on the rise for the past years and decades, and will likely to continue to rise going forward. So I think companies that offer a solution to that growing epidemic will have pretty good growth potential going into the future. Okay, so now we know what their revenue streams are. The question really becomes, what's the long-term potential, the long-term growth potential of these industries that they're operating in, the various services they're providing. So we looked at cybersecurity, EMR, telehealth, and even the clinics themselves. And I'm not an expert in the healthcare industry, right? I'm not going to stand here and pretend like I know something that no one else does, and I can point to all this research and explain why these industries are going to be the next big thing, because I don't know that, right? It's very hard to predict those types of things, and you really need to be immersed in this industry and know a lot and have very good foresight to be able to predict what the future might hold for this industry as a whole. My advice to you, if you are interested in investing in this company, is you need to be able to answer certain questions about this company. So questions like, how big are the markets that WELL Health is operating in projected to become 5 years in the future, 10 years in the future, 20 years in the future? And will WELL Health actually be able to carve out a significant market share in those markets, enough to become sustainably profitable? Or will they just get eaten alive by competition? Because certainly for the electronic medical records business, that is very high margin, and there is probably going to be a lot more competition going into that industry. So for example here, just doing a quick Google search looking for some of the larger players in the electronic medical records industry within Canada, I found this here. Now this is as of January 1st, 2017. So these market share numbers you see here probably aren't accurate anymore. But as we can see, there are some pretty large competitors. For example, TELUS Health Solutions, which I'm assuming they're backed by TELUS, which means they're probably very well funded, and they're going to be difficult for an upstart company like Well Health to compete against going into this industry. And if I'm potentially thinking of investing in Well Health, I'd also want to answer questions such as, what are their contracts like when it comes to their software services, right? Are they short-term contracts? Are they long-term contracts where the customers stay locked in with them for a long period of time? Or if they're short-term, then you're probably going to have a much higher churn rate of customers, and there's probably going to be higher marketing costs associated with that in order to bring more customers into the business. So these are all things that I personally would want to have answered before I really make a final decision on whether or not I think this company would be a good investment and if they can actually remain competitive in this industry, because these are all things that provide very valuable information. And personally, when it comes to thinking of sales and thinking of future profitability, especially for businesses that are software as a service, you want to understand the nature of the contracts that they sign with their customers. So those are all, I think, very important things to consider, but I think going in depth on all those things is really outside the scope of this video. What I really wanted to focus on was give a quick overview of the business, look at their financial statements, and then try and come up with a reasonable valuation of them about 5 years out. So that's what we're going to do now. I'm going to open up their financial statements. They only have really about 2.5 years of historical financial data, so we can just look at one set of financial statements and we'll get a pretty good idea of it, and then we'll go into the valuation. Okay, so I've jumped back into their most recent quarterly filing, and we're looking here at the balance sheet. And whenever I look at a balance sheet, I'm looking for a few key things. So first, cash, right? So they have about 83 million in cash, which is expected. They need to have a high amount of cash, especially compared to the total current assets, which is 94 million, because they're making so many acquisitions, right? That's really what their business is. It's to acquire other companies and consolidate them, and they need cash to do that. So it's good to see a high cash balance there. And then, so 94 million in current assets. If we look down here, total liabilities of 42 million. So that current liabilities here of 22 million. So very strong current ratio. They have more than enough cash on hand, and they actually have enough cash on hand, 83 million, to pay off all their outstanding liabilities. So they have a very well-funded business, and there's not going to be any short-term liquidity issues with this company, which is a great sign. So you have nothing to worry about there. And I also like to look at what their debt to equity ratio is. So debt to equity is just total liabilities divided by total equity. So I would also expect this to be extremely low, and I also expected to see a lot of share capital, because when they make acquisitions, they use cash for acquisitions, but they also, for their larger acquisitions, will have to use share capital. So that's what we're seeing here. So 230 million share capital. This is an account that's probably going to increase quite a lot going forward as they continue to issue more shares to make these acquisitions. So as a shareholder in this business, you are going to get diluted going into the future, but that's really what you'd expect, right? Just getting diluted is just the nature of being a part of this business. So very strong equity in comparison to their liabilities. So again, overall a very good balance sheet and nothing really to worry about there. Okay, so now I've scrolled down to the cash flow statement. So what I look at when I look at the cash flow statement is at the top you'll see the operating activity section, and it always starts with net income or net loss in this case, and then it makes certain adjustments to get to net cash provided by operating activities, so cash flow from operations. And you always want to look for kind of these two numbers here to see if one's negative and one's positive, which it is. So they reported the net loss, but they actually had positive operating cash flow. So this could be for a number of reasons. It could be for some of the companies they acquired. Maybe they just had positive changes in working capital just because when they were consolidating their financial statements to bring in those new companies. There can be many different reasons. Also, if the company has large depreciation and amortization expense, which we can see that here, it's not that large for this company just because they don't spend that much on capital assets, which we can check down here. If we look at the investing activity section, we can see right here, acquisition of PP&E, property, plant, and equipment. So very low, which you expect that for a software company. So going forward, once this company is able to establish themselves, you want to look at cash flow from operating activities minus capital expenditures to get a good idea of what their free cash flow is. And usually for software businesses, it's going to be pretty high. They don't have to reinvest that much into their PP&E. And if they are profitable, then this number should continue to go up. We could also see share-based compensation was a pretty large expense, almost 3 million. So this is a non-cash expense. It's essentially just the value of stock options granted to executives and employees. But it is a necessary expense because you have to pay them stock options. That's why they work for your company. And then there's this change in non-cash operating items, which is the biggest one, which is about $3.5 million. And that's really what kind of these three things combined is what drives the change in their operating activities to positive from a negative operating income. Now, the last thing I want to point out before moving into the valuation is I've gone back to the MD&A section and looked in the Outlook. So the Outlook part of the MD&A section is really where you're going to find a lot of their future goals, right? A bit on their business strategy and also just a discussion of what they plan on doing in the future. And what we can see here is that they talk about their outlook for Q2, which was driven by this large acquisition they made of a company called CRH Medical. And what I've noticed it says in here, it says it puts the company on an annualized revenue run rate approaching 300 million. So basically 300 million in annual revenue. So that's up significantly. So when they report their next quarterly filing, you can expect to see an extremely large boost in revenue from this acquisition. And when they do their annual financial statements for the end of 2021, you're going to see a very large increase in revenue because of this acquisition. So once that comes out, we can take a look at that and see, how they financed that deal. It was probably mostly with shares, but also some cash as well. And then they talk about the benefits of it. So they say it significantly boosts Wellhealth's cash flow, which they can make additional cash flow generating acquisitions. It accelerates their revenue and EBITDA growth profile. It represents a significant tech enablement and various other positive things. So they are very high on this acquisition. So it'll be interesting to see how this plays out with them going forward. Okay, so when it comes to valuing a company like this, it's going to be very difficult to do. And this is just because of the sheer number of acquisitions that they're making. And as their revenue continues to grow into the future, that growth is going to be a blend of organic growth in the business from the acquisitions they've previously made and growth just because they've acquired more companies. So now their revenue is higher because it's accounting for the revenue from the new companies they just acquired. And so that's something you got to do is you got to separate out organic growth in the business versus just growth from acquisitions, which is very difficult to do. And to be honest, even if you ask this company's management to do that, they would probably have a difficult time doing that. So that's really something you got to be aware of. And a key risk to investing in this company is the fact that they just make a bad acquisition, right? It's very possible that they could overpay for a company and destroy shareholder value instead of creating it. With certain acquisitions and certain companies that they buy, if they just end up being bad buys and they aren't good fits. Acquiring companies is not something that's easy. It's tough to onboard so many companies and to do what they're trying to do, which is create a much larger consolidated company just by going out and buying all these different companies operating in different environments. But with that in mind, we're going to do our best here to try and determine what the revenue will grow to by the year 2025, and then we'll take what's a reasonable EBITDA margin, and then do the EV/EBITDA multiple earnings approach to try and get an estimated market cap. So I'll show you what I did now. Okay, so all these numbers are in thousands of Canadian dollars. And as you can see here, I've split out their revenue. So I've got the yellow here, which is historical data. I've split out their revenue based on the four sources that we saw when we were looking at their financial statements. But when I was forecasting it, I didn't bother splitting it out, just because I think that's going to be really difficult to do because it really depends on which acquisitions they make and which category those fall into. So I just kind of went with a total revenue number here. So 2019 total revenue was 32.8 million. It then grew to 50.2 million. Now with this acquisition of CRH Medical, as we saw before, it brings their revenue run rate to about 300 million. So don't be surprised if when their 2021 annual filing rolls around, they report a massive increase in revenue. Don't think that that's news to just jump on the stock immediately. It's just because they made acquisitions, right? It's not really, so I'm not predicting 350% organic growth here. And I got this number just based off of estimates from what I saw with analysts, as well as what I read in the actual filings. I then assumed 100% growth rate for the next 2 years, and then 50% growth rate into 2024, and then 25% growth rate into 2025. And these are just ballpark estimates, right? The whole point of this model is just to build, a certain valuation of this company, and then we can determine if these growth rates are reasonable, because these will consist of some organic growth, but mostly growth through acquisitions. So then if we move over here next, we can see at the top, so this is 2025 here, predicting about just under 1.7 billion in revenue. So again, maybe they'll reach that, maybe they won't, depends on their organic growth as well as their acquisitions. But based on that, let's just for the sake of it assume that that does happen. How can we value this company? So about a 20% EBITDA margin, which is fairly standard for software related businesses, which they will mostly be a software business going forward, and the EMR business is generally very high margin. So then we get an EBITDA of 337.5 million. I then take a 15 market multiple there, so EV/EBITDA. which is about average what it is for the past 5 years. I just did some basic research on health IT businesses, and over the past 5 years, 15 was kind of in the median there. So we get an enterprise value of just under 5.1 billion. I assume no debt, which maybe they'll take on some debt, maybe they won't. I just imagine the debt they take on to be very low. And when we were looking at their balance sheet, we saw extremely low debt. They didn't have any long-term debt really. Usually for software businesses, they don't take on long-term debt just because it's hard to kind of secure debt from a bank because they don't have any hard assets that they could use as collateral for it. But with those assumptions in mind, I also added 100 million in cash. Again, that's just a ballpark estimate. It doesn't really affect the valuation too much. The big part of the valuation is going to be the equity part, which we get an estimated market cap with those assumptions in mind of just under 5.2 billion. Now, shares outstanding. I had to get pretty creative with this, so we know shares outstanding are going to increase. That's just the nature of what's been going on. So the way I kind of estimated this was, if we look over here, so this was at the end of, so this is December 31st, 2018 to December 31st, 2020. So a 2-year difference here. And we can see their shares outstanding roughly doubled from 82.5 million to 166 million. And over that time period, they made 16 acquisitions, so 6 in 2019 and 10 in 2020. And we know that acquisitions are going to be a very strong driver of growth in the number of shares outstanding. So if we look at that on a increase in shares per acquisition made basis, we get about 5.2 million increase there. And then if going forward, if we assume they stay at this rate and take 8 acquisitions are made per year until the year 2025, so that's what's going to be a big driver of this revenue growth up here is the acquisitions as we discussed. So I took 8 just because it's the average of the 2 years there, 6 and 10, 8 is in the middle. So it seemed reasonable to make. So if we assume shares grow at that rate from what they are now, by 2025 they'll have about 375.7 million shares outstanding, which gives them a price per share of 13.74. And you can currently buy their shares in the public market for about $8.50. So then the average annualized return for that over that about 4.5 year period is 11.27%, which is a pretty solid average annualized return. The market on average does about 7 to 10% a year over long periods of time. So this is slightly above market. And what I've also done down here is because the number of shares outstanding is a very key driver in what an average annualized return you can expect, we can see how our average annualized return here changes depending on how many shares outstanding they have as of this point in 2025, again, given all these revenue and EBITDA margin and multiple assumptions we made, assuming all those come true as well. So shares outstanding, if say instead of 375 million, they're 300 million, our average annualized return goes up. It's a lot more attractive, almost 17%. But say they need to issue a lot more shares in order to make acquisitions. And there's going to be other things that increase their shares. It can be, the exercise of options. Maybe they just issue more shares to the public market for funding. Whatever the case may be, their shares are going to change. But say they're 500 million instead of what we estimated here, which is 375 million. You can see how that impacts your average annualized return. So it goes down quite a lot depending on the number of shares. So that really illustrates the effect that dilution has, again, given all these other revenue and margin and multiple assumptions if they come true. Okay, so an 11.3% estimated investment return. That is pretty good. Now, does that mean we should just drop everything we're doing, go out and try and buy shares of this company? No, of course not. There are still some risks. And keep in mind, this valuation that I did here is extremely rough. And we know that pretty much everything that I have in here is not going to end up becoming true. But it does give us a good general sense of putting their current valuation into perspective and seeing what kind of an investment return we could expect to get. But for me personally, the main hang-up when it comes to investing in this company is what it is. I mean, they're an acquisitive company. They're making tons and tons of acquisitions. And the risk of them overpaying for an acquisition goes up with each acquisition they make. But as I was talking about at the start, the healthcare industry, specifically the software side of the healthcare industry, is a very interesting one to invest in. I think there is potential for very good long-term growth into the future, but you just got to find the right company. And maybe this company is it, maybe it isn't. But again, just kind of their strategy and how many acquisitions they're making is a really big hang-up for me. So I would probably be avoiding this company. But again, there definitely is potential in this company. They just need to do the right things. And from what I read very briefly about their management, they have a history of doing these types of things successfully. So there definitely is potential in this company. So if you are interested in the IT healthcare space, this could potentially be a good investment to look into. But anyways, guys, that's my take. So thank you so much for listening. I hope you enjoyed. Hope you found this analysis useful. If you did enjoy the video, please leave a like and subscribe if you're new. And I'll see you in the next one.